Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
So what's the best new feature you're working on that's going to excite people in a year or two or something like that?
If I told you that, we would have to do the Men in Black thing.
Oh, okay.
Welcome back. Starbucks aims to reopen 90% of its US outlets by mid-June, in line with a strategy it developed during the early days of the outbreak here in China. Starbucks' CEO Kevin Johnson spoke to us earlier.
We started working on the COVID-19 response in China in mid-January, and so we're now in week 15 in China. And we've learned some very important things from that experience. You know, the first is that there are phases that every market around the world goes through. And the first phase, you know, we really refer to that as sort of the mitigate and contain phase. And that's that period lasted for 3 weeks in China, where people were asked to shelter at home, businesses were shut down, social distancing, all with the focus on how to flatten the curve and slow the spread of the virus. Coming out of the mitigate and contain phase in China, we then transition into a phase that we call monitor and adapt. And monitor and adapt basically means we begin to reopen stores, but we reopen them with different store protocols, you know, amplifying safety. Oftentimes it's for mobile order for pickup only. And we did that in China, while at the same time we monitor the number of COVID cases that might pop up in cities around China. And in the US here, we are now just coming out of the mitigate and contain phase. We've been in that for 6 weeks now in the US. And as we transition into this monitor and adapt phase, you know, we plan to reopen over 90% of our Starbucks stores by early June. In fact, next week, the majority of those stores in the United States will reopen. And we will reopen using safety protocols that we developed in China and have adapted for the US. We'll reopen in a way that provides our customers a safe, familiar, and convenient experience. And so we're excited for next week. Many of our Starbucks partners are referring to it as homecoming week, because they too, like all of us, have been sheltering at home, and we're ready to get out and do something, but do something that's safe and responsible. And that's the balance that we work to strike in this monitor and adapt phase.
As you say, Kevin, as you came back online and you have the vast majority of your stores now in China back up and running, as I understand, you have modified your hours, modified how many people can be there. I see that the same store sales, even though you have almost all the stores open, are down somewhat. Can you tell how much of that is just reluctance on the part of consumers to come back out and buy things, as opposed to just having fewer people in the stores and shorter hours?
Yeah, it's a combination of all of those things, David, and I can't necessarily attribute it to any one, although I do know that, you know, in our store protocols, for example, in China, you know, most stores are not open for seating. They're open for customers to come in for takeaway in China. And some stores have limited seating so that we can enforce social distancing. And one of the differences between China and the US, in the US pre-COVID, over 80% of our customer occasions in the US were for takeaway or to go. And so The U.S. consumer was much more sort of on the go. And so we think opening in the U.S., we're going to get a very significant result. But the positive news is every week we see continuous improvement in China as we monitor and adapt. We turn the dial up slowly and start to open limited seating, open other services. And now as we begin that path in the U.S., we're very optimistic that, by the end of May, early June, we're going to have a much better perspective on how quickly this is going to recover.
Kevin, do you have any projections on how the overall state of the economy and the employment situation might affect consumers coming back to Starbucks stores right here in the United States? We now know officially we are in a recession. It's going to get worse. Is this something that really could put pressure, downward pressure on your volume?
Well, certainly Starbucks, we've gone through recessions in the past. And if the past is an indicator of how customers behave, we think we're going to be in a very, very strong position. We work to have a premium experience and build long-term loyal customers. And, what we offer is an affordable luxury. And even in times, of a recession, customers are looking for something to uplift the everyday. And if it's their daily Starbucks or maybe they cut back a little bit, but there's an affinity that customers have for Starbucks, and we work hard to earn that loyalty and that trust. And that's what has carried us through recessions in the past.
And that was a Starbucks CEO, Kevin Johnson, there. Well, India's largest company by market value is planning to sell shares to its investors for the first time in 30 years as a steps of efforts to pay down debt. This is the third fundraising Reliance Industries has proposed in recent weeks. Let's get more now with India conglomerates reporter PR Sanjay joining us from Mumbai. Sanjay, what do you make of this proposed rights issue?
Oh, this is very interesting because this is happening for the first time in last 30 years. And this is also showing some kind of confidence of promoters in the company. And this, as you rightly pointed out, this is the third time companies announcing a capital raising program in recent weeks. First one was they announced ambitious Saudi Aramco deal, which has been delayed because of various issues with oil carnage and COVID issues. And the second one, the most recent, was Facebook deal. And this was the third one. This will actually inspire some kind of a confidence among investors as well. And this will also, the street is expecting that this will help the company to bring down its net debt level to zero by next year. So,
Okay, I think we just lost the line there. A technical gremlin. These things happen in TV. But this was just getting a line on what was happening with Reliance. But let's get back now to PR Sanjay. Sanjay, listen, in terms of what investors are going to be looking at when it comes to these Reliance earnings, what else are they going to be focused on, do you think?
They would be looking at any commentary on the potential Saudi Aramco deal, which is like very critical for their ambitious program of reducing, or rather making a net debt level to zero. And they will also be looking for additional commentary on Facebook deal. And definitely they would be looking at what are the proportion, what are the ratio for the proposed big the rights issue planned, announced by the company.
All right, PR Sanjay, thank you. Our India conglomerates reporter in Mumbai with what to expect with Reliance, of course. Taking a look at the next hour of Markets Asia, we're going to dig into more earnings uncertainty and speak exclusively with the Fortescue CEO, Elizabeth Gaines. Plus, we have MasterCard's Ari Sarkar, the co-president for Asia Pacific, joining us in the next hour. You don't want to miss both those interviews. Fortescue, of course, we'll talk a bit more about them cutting their CapEx plans and, of course, the rising tensions that we're seeing in Australia and China now as well. Keep it here. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index, true diversification.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's almost 11 o'clock in Singapore, 8:30 a.m. in Mumbai. I'm Haslinda Amin.
And I'm Yvonne Mann. We are entering the last hour of the morning session here in Hong Kong, although we are closed, of course, here today. Let's take a look at markets and, of course, what we're looking at. Asia-Pacific markets rise on hopes of a treatment for the coronavirus. Oil futures rebound and the dollar recoups some of this week's losses. President Trump sees light at the end of the virus tunnel. He says he may punish China for the pandemic and warns Beijing wants him to lose the election. And Fortescue sees robust iron ore demand as China reopens. We are joined exclusively this hour by Group CEO Elizabeth Gaines. This is Bloomberg Markets Asia.
And Vaughn, Asia strongly in the money after that strong rally overnight in the U.S. There's, of course, optimism after we saw gains in earnings from Facebook, Tesla, Microsoft. They're providing some support. There's also optimism. We're making progress in the hunt for a vaccine, and the Fed says no rush to end the stimulus. Strong gains in the region. The MSCI is trading up by more than 1%. It's already back in bull market. We're set for the best month in 4 years. The Nikkei 225 also trading higher by 2.5%. Japan back from a holiday, playing a little bit of a catch-up. Retail stocks, auto companies leading gains. Honda, Toyota among them. Japan factory output, though, falling again in March. The CSI 300, it is up for a fourth day, higher by about 1% right now. Investors pretty much brushing off China April factory PMI, which missed estimates by a little, but expansionary 50. Taking a look at where we are in terms of the dollar index, up by about 1/10 of 1%, pretty steady. The peso weaker, though, at 50.49. Vaughn.
All right, taking a look at other assets, of course. Oil still remains the big focus this week, and we've seen a decent rebound here in the last 48 hours or so. 12% gains for WTI. This is the June contract, of course. Brent also higher by 9%, so we are extending those increases, I should say, during the Asian session. U.S. 10-year hasn't really moved too much in the last couple of days, but we certainly saw some big moves after the Fed meeting on the 2-year yield, hitting the lowest in 9 years, and we are seeing U.S. futures actually a positive positive now, up about 1/5%. Take a look at India markets. This is the setup for the session in Mumbai here today. We do have a lot of markets going to be closed today as well as tomorrow. So pretty shortened trade for this week. Nifty futures up, take a look at that, 2% higher here today. The rupee last close at 75.67. So we still saw some strength coming through, and your India 10-year yield not moving too much at 6.12. Let's get to the first word news now. We're watching, of course, the latest when it comes to President Trump saying he sees light at the end of the tunnel in the fight against the coronavirus, with the fourth quarter of the year to be, quote, really, really good. Meeting U.S. business leaders, he said the coming months will be a transition period, echoing predictions from his economic advisors. The White House has been urging states to consider reopening their economies as the number of new cases slow. Japan's 47 prefectures are set to ask the government to extend the state of emergency as coronavirus numbers continue to rise. Tokyo's Yuriko Koike said the situation remains severe. Unemployment claims are surging in Southeast Asia, with almost 9 million people registering for aid in Indonesia. And the labor market is slumping as well in Singapore amid its sharpest contraction since SARS in 2003.
Germany sees the pandemic pushing the economy to its worst recession since World War II as business and household confidence collapses across Europe. GDP is forecast to fall by more than 6% this year, more than in the financial crisis, with the low point expected sometime in the second quarter. The government hopes its trillion-dollar rescue package will help limit the damage. And industrial production fell for a second month in a row in Japan as the coronavirus increasingly disrupts global supply chains and demand. Factory output dropped 3.7% in March, following a smaller decline in February, although the fall was smaller than economists had expected. A separate report shows retail sales slumped 4.5% from the previous month.
Well, policymakers are fighting back against the coronavirus, from Fed Chair Jay Powell saying more needs to be done in the U.S. to the PBOC pumping in stimulus to protect exporters in the deepening slowdown. Let's get to our global economics and policy editor, Kathleen Hayes. She's here with a look at the key gauge, of course, with the China PMI numbers that we just saw. So, Kathleen, would you say that China is winning the war against the virus?
Oh, well, the problem for China is, Yvonne, is that China does seem to have won the war in terms of getting people back to work, in terms of the turnaround we did see a couple of months ago in China's key manufacturing PMI. But, you know, China can't fight the rest of the world's wars, can it? And as the pandemic spreads, we're seeing this hitting China. The manufacturing PMI, of course, slipped to 50.8 in April from 52. Service is doing better. The services PMI going up to 53.2. But it's pretty clear when you look at the manufacturing PMI, and if you throw in the Caixin PMI as well, which brings in the small and medium-sized companies, you can see that there's export headwinds. They're on the rise because the pandemic has spread. There are reports of new orders getting canceled. And speaking of orders, let's jump into a really great Bloomberg chart, because you have to look inside here to see what is happening to exporters. Overall, new orders are pretty steady around 50.2. That's the white line. But if you jump to the dark green line, new export orders down to 28.5 in February. They came back to the mid-40s, down to 33.5. New export orders in April looking pretty bad. And again, you know, this is because we see the U.S. having this dramatic slowdown. We have Europe in a dramatic slowdown. Again, I think they're not winning. They maybe won their own war, but now they've got to see what happens to everybody else. And it was very interesting when Jay Powell was speaking today and answering reporters' questions after the meeting, where they didn't change anything. Key rate still near zero. He had three big medium-sized risks, or medium-term risks, I should say. And one of them was the risk that this global slowdown is something where everybody gets hurt. We all get hurt together. We potentially go down together. I think it was very, very prescient ahead of what we see in China for him to make that remark. But clearly, it is a worry for a lot of policymakers.
And Kathleen Powell saying the Fed will keep rates where they are and use all the tools, and still more needs to be done.
Isn't that something? Because some people thought, well, maybe he's going to signal something about eventually down the road, we're going to have this stronger rebound and discuss this issue of when you might raise rates. Far from it. He said the economy basically needs more help. Forceful measures to contain the crisis have halted the economy. This heartbreaking situation for so many workers. He says the current rate stance is appropriate. It's going to stay in place until a solid recovery is underway. And when he was pressed further about more steps from the Fed or the Treasury, he said they need both. Let's listen to what Jay Powell said earlier.
Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
And what underscored this well, U.S. GDP in the first quarter shrinking at a 4.8% annualized pace. The 11-year expansion is over. The recession has begun. The worst decline in the economy since 2008, when the great financial crisis, Great Recession, were just getting underway. Consumer spending down nearly 8% year over year. And you know what? Jay Powell talked about an unprecedented contraction in second quarter GDP. Bloomberg Economics is looking for a 37% drop in GDP in the second quarter. UniCredit looking for the biggest one in the survey, 65%. And when we get those payrolls numbers a week from Friday, supposed to see payrolls shrinking by 22 million. So clearly, Jay Powell's looking down the road and seeing at this point, it's not over. The battle continues.
And the markets brushing that off. Our global economics and policy editor, Kathleen Hayes. Still to come, we unpack MasterCard's latest results and find out how payments are being affected by the pandemic. Our exclusive interview with Asia-Pac co-president Ari Sakar is later this hour.
But just ahead, the head of one of the world's biggest producers of iron ore joins the show to discuss its latest shipment guidance. We'll ask what we can learn about China's recovery from Fortescue CEO Elizabeth Gaines. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Well, Fortescue Metals has reported a 10% rise in third quarter iron ore shipments. It also raised its annual shipment forecast despite the pandemic. The miner added that it sees strong and ongoing demand for its products from the world's top metals consumer. Let's bring in Fortescue Metals Group CEO Elizabeth Gaines, joining us exclusively from Perth. Elizabeth, thank you so much for your time today. Tell us a little bit more. We just got the China PMI numbers, and it still shows a bit of an uneven recovery there. What is Fortescue's read on the recovery in China right now? And is it safe to say that in terms of steel output in 2020, it could top, I should say, last year's volumes?
Well, we've already seen good calendar year performance in Chinese crude steel production. So for the first quarter, Chinese crude steel production was around 234 million tonnes, and that was actually up 1.2% year on year. And throughout this whole period, we've seen very strong underlying demand for iron ore. So we've been shipping in accordance with our usual schedule, and we've actually seen iron ore stocks held at ports in China actually been drawn down quite significantly as well, by just over 11 million tonnes since the end of 2019. So we are seeing economic activity resume and pick up. We're seeing steel inventory start to decrease, and we're seeing very strong demand for iron ore. And that's evidenced by our record third quarter that we've just announced, where we've shipped 42.3 million tonnes in the third quarter. And that is a record for Fortescue. And for the 9 months, we're at 130.9 million tonnes.
But we've seen when it comes to the steel industry in China, they've sent up a warning as well in terms of the nationwide stockpiles. We just showed a chart of that. When it comes to construction staple steel rebar, that swelled to a record in March. Does that in any way dampen the expectations of Chinese imports?
It did swell to a record at March, and we were actually monitoring that very closely because it is an indicator of economic activity. But we have seen that those stockpiles have started to reduce as we came into April. And that really coincided with some of the easing of restrictions on the movement of finished steel products around China. So we are starting to see those steel inventories come down. And whilst they did peak at the end of March, they were still only a tiny proportion of the overall steel production last year of nearly 1 billion tonnes of crude steel. So whilst there was that increase, as we've seen economic activity recover and we're starting to see those stockpiles draw down, we certainly aren't seeing any impact on demand for iron ore. We have seen some supply disruptions for iron ore from other producers. In Brazil, for example, where there was exceptionally wet weather in the start to this calendar year, and from some of the other producers in the Pilbara where we operate, they were impacted by wet weather as well. So a combination of some supply disruptions, coupled with what we're now seeing is that resumption of activity and the drawdown of steel inventories, is really underpinning that strong demand for iron ore.
Now, Elizabeth, we're seeing miners cut their forecast for CAPEX. Will that delay any of your projects? Are you intending to perhaps cut down spending?
We're continuing with our major projects. So we've got 2 major projects under construction at the moment. First is the Eliwana Mine and Rail project, and that's a $1.275 billion project that will reach peak construction numbers at around about the middle of this year. And we're on track for first ore on train in December 2020. And our other major project is the Iron Bridge Magnetite project, and that's a $2.6 billion investment, again in the Pilbara. And that's first magnetite concentrate on ship will be in the first half of calendar year 2022. So we're not certainly slowing down on any of our investment. In fact, we're really committed to these major projects. They are creating jobs, creating up to 5,000 jobs during construction and 1,500 jobs once operational. So I think it's really important that the mining sector is actually really underpinning that further investment and growth, particularly here.
Are you also committed to your dividend payouts? I mean, can you maintain the level of dividend payouts given expectations of an economic slowdown?
A record hand 0.2 times is actually of 100. Now we did in April
All right, Elizabeth, hold on a second. We have to establish a connection again because you're breaking up a little bit. That was the Fortescue CEO, Elizabeth Gaines, there joining us from Perth. We'll try to establish that and fix the problems there before we bring her back. Apologies for that, of course. Coming up, we're talking about more with Fortescue, Elizabeth Gaines. Just keep it here. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
products that are in that sort of 58 to 60 grade of iron ore content.
And, you know, many major mining companies like Fortescue, you certainly have the balance sheets right now to really kind of sort of rival some of your competitors out there. Are you seeing any kind of M&A opportunities out there, given just how distressed the rest of the industry is?
Well, I think you're right. I mean, we're in very good shape, and our balance sheet has never been in better shape. But we do have two major projects that we're in the process of constructing, and they are significant investments in their own right. You know, close to $4 billion US. So we've got a strategy for growth. But we do have an active business development team, and they look at opportunities. And you know, we actually are focused more on exploration. So we've been putting money into the ground to explore for other commodities, including copper, in Ecuador and in Argentina. So that's been our focus in terms of growth and diversification. But we certainly are very active in looking at other opportunities that may arise.
Elizabeth, S&P has just filed a lawsuit accusing your company of suppressing information on global iron ore prices. What is your response to that?
Well, this is an ongoing matter that, you know, there's commercial sensitivities in that, but it's really to do with the disclosure of what is confidential information, and that's really all I can say on the matter.
Elizabeth Gaines, thank you so much for your time. That was the Fortescue Metals Group CEO joining us exclusively from Perth. Thank you so much for dealing with all of our audio issues here today. Let's take a look at markets right now when it comes to China as they head to that lunch break. We've been watching a little bit more about the Asian stocks, and in particular after we re-entered that bull market. Asia on track for the best month in 4 years, but Chinese stocks have actually underperformed their Asian peers by the most in 2 years. But we're seeing some decent gains here, 1% moves across the board for the CSI 300. A shares, Shenzhen as well, having a good day. And we're watching some of these airlines as well. They're actually rising here. We heard from Beijing, the city there, lowering the emergency level from this coronavirus to the second highest from the highest level. So that certainly is helping. Also, of course, digesting some of the earnings that we got here. But you're seeing the likes of China, Southern Airlines up close to 4%, Air China up close to 5%. So that certainly is good news on that front. But of course, we've seen the big three Chinese airlines losing $2 billion as this virus kills travel as well. Let's take a look at GMM broader moves here as we wrap up. Of course, it's a shorter trading week with most markets closed tomorrow as well. And Haz, what are you watching?
Well, that's right. I mean, the market's getting a lift from all the strong earnings from the likes of Facebook, Tesla, giving investors pretty much a lot of confidence. Optimism about the vaccine as well. We're looking at the Nikkei back from a holiday trading up, playing a bit of a catch up. The TAIEX also higher, the likes of TSMC, UMC, MediaTek, ASC, all getting a lift from the great technology earnings that we saw earlier. And, you know, if you take a look at the gold, how gold is doing as well. Gold heading for the biggest monthly gain since 2016, Vaughn. It's been boosted by unlimited stimulus from central banks. We're on watch for the ECB action today. The BOJ, of course, boosted stimulus earlier in the week. Plenty more to come. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Bloomberg Television around the world.
We're looking at live pictures of the Lion City, almost 11:30 a.m. in Singapore. We're in the middle of the trading day. The STI, never mind those clouds out there, up by more than 2% today, 2,629. Joining in the rally that we're seeing pretty much across all of Asia, and of course Singapore. 5G is the inward right now. Singapore's communications minister saying earlier this morning in our conversation that carriers awarded with the 15-year licenses to operate 5G networks offering fast data transmission will have enough time to recover their investment and make money. Of course, lots of questions on whether or not they can make money after that vast investment in 5G. The STI currently up by more than 2%. For now, let's get the first with headlines with Karina Mitchell in New York. Karina.
Hey, Linda. Fed Chair Jerome Powell says the coronavirus has brought the economy to, quote, an abrupt halt as he held interest rates near zero and pledged to keep them there until the U.S. is back on track. Powell talked of the heartbreaking harm the pandemic has caused and said activity will likely fall at an unprecedented rate in the coming months. He said there may be a need for more Fed action to support the recovery. And the first official reading of the Chinese economy this month shows manufacturing moderating, indicating the recovery from the first quarter slump may be prolonged. The official PMI gauge slipped to 50.8 from 53 in March, according to the National Bureau of Statistics. The result shows the continuing and wide impact of the virus on output and demand. Now, Hong Kong says the economy will contract by as much as 7% this year as the virus fallout adds to pressure from months of anti-China protests. The advanced first quarter GDP reading is due out Monday and may be worse than was seen during the financial crisis. Hong Kong has been in recession since the second half of last year, with tourism, retail, and entertainment battered and coming under severe pressure. Here in the States, President Trump says he thinks China wants him to lose the election because of his response to the coronavirus outbreak. He declined to offer any evidence for his claim, but told Reuters that he's considering how to punish Beijing for allowing the infection to spread globally. Washington and Beijing have been firing barbs at one another over the pandemic for weeks. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, the coronavirus pandemic is changing the way people pay for purchases. In the age of social distancing and lockdowns, more and more are switching to contactless payments, and in that regard, Asia-Pac leads the world. Joining us now, Ari Sarkar, co-president Asia-Pac at MasterCard, which, by the way, also released first quarter earnings overnight. Ari, Q1 earnings beat estimates. Give us a sense of how much Asia contributed to that. How strong is Asia looking?
Thanks, Linda. Well, to be honest, we came out of 2019 with some really strong momentum. And the month of January, we sustained that momentum. And as you well know that, and pretty much across the world, we've seen the whole lockdown thing happen. And Asia is no exception. We've seen a significant slowdown in consumer spending behavior just with the nature of the lockdowns. And on the backdrop of that, I think we delivered a really strong quarter in the first quarter. And I would add that, it's more than just transactions. I think what we are really focused here in the Asia-Pac region is things around service verticals, which we've been investing heavily over the last, I'd say, 10 odd years, and really creating more diversification in the revenue pool from analytics to cyber and intelligence. And I think that's the story for us in our first quarter results.
The story ahead, though, is about an economic slowdown. How concerned are you about payment defaults among your customers, given that unemployment is rising and growth is just easing in a big way?
Well, from a MasterCard standpoint, this is really for our banks who are essentially focused on risk management and making sure that credit portfolios are performing well. They're making sure that, recoveries and collections, that's a priority, big one for them. For MasterCard, we as Linda don't take any of that balance sheet risk. We are in the transaction business. We are in moving money from point A to point B. And I think when you look at that, our view is that, yes, at the current time, we really feel that in the last few months, we have seen almost hit the bottom. You've seen it through March, we've seen it through April, and now when we look at our numbers, at least the volume numbers, we feel that we are probably getting to a level of stabilization. And we're looking at this in 4 different phases. It's containment, which was in the early part of the year, as governments scrambled to make sure with the lockdowns to prevent the spread of the virus. And now I believe we are in that stabilization phase. Now, how long the stabilization phase will take before getting to what we call normalization, where we will start to see some sectors of the economy positively rebound, and then finally growth, I think it's early days. We'll just have to play this over the next weeks and months, and hopefully we'll get there sooner from stabilization to normalization. Contactless is a big play for us. We've been investing heavily in this space, and now what we've seen is in the course of March, we've seen a very rapid shift towards contactless. In Q1 itself, we've seen over 40% growth in contactless transactions, and we believe that is going to continue to shift further in the coming weeks and months.
Yeah, I want to get to your study in just a bit, Ari. But first, cross-border payments. You saw volumes fall some 1%. And this is usually tied to travel, hotels, restaurants as well. Are we likely going to see continued pressure amid some of these lockdowns we're seeing in the region, as well as people just still not traveling? And will it only get better once these travel restrictions get lifted?
Yeah, you're absolutely right, Yvonne. I think the cross-border side, where it involves physical movement of people, whether it's, airlines, whether hotels, that has completely been hit really hard. And I'm sure you're talking to each of these sectors, as well to get a sense of it. My sense is that, it will take a little longer on cross-border where travel is involved. However, what we've seen is e-commerce is coming in, and, e-commerce on cross-border has actually been quite resilient. And then if you look at our weekly trending data, e-commerce clearly is one of the bright spots. Now, whether that will sustain, again, we watch this really closely. Time will tell, but there is a little bit of a hedge when you're losing travel. You're getting a little bit of a lift with e-commerce, growth.
And Ari, you mentioned about contactless payment. You're seeing jumps of 40% or so during this pandemic. There certainly is a lot of competition, though, when it comes to not just contactless payment, but mobile payments as well. I mean, you have non-bank players like Alipay, WeChat Pay, Globe that have pretty strong footholds right now. You also have Asian banks kind of taking part in the space as well. How much are you willing to kind of continue on this trend and invest to not just get more users, but also retain them?
It's a great question. When you think of contactless, one is contactless as we all use in the physical card. But contactless is also going into devices. Whether you're talking about the wallets, whether you talk about Apple Pay, whether you talk about Samsung Pay, a lot of that is actually powered by, MasterCard. So when you register your card credentials in any of these wallets, you're actually, the technology called tokenization, we are storing the token in those devices, which enables, secure payments through those devices. So our view is that irrespective of what the form factor will be, we should be relevant. And whether you're moving from a physical plastic or you're moving into devices, we see a role for MasterCard in the years ahead. And that is precisely what we are driving with our contactless and what we call near-field communication, NFC strategy of enabling payments through devices as well.
Ari, MasterCard has said that it wants to pare down costs. Will that impact your plans and your strategy in Asia? Could that impact perhaps hiring?
Well, Aslinda, we've made a very clear commitment that, through this difficult period, which is causing enough suffering at a human level, the commitment we have made, and we still stand by it, that we are not looking to have any type of, headcount reduction or efficiency of cost out, which will have impact on people. That's a very big statement for us. Again, this is with a point of view and with outlook as we see today. Whether that will change, I can't comment on that, but that is a conscious effort that we are making. Now, as far as our overall priorities in the region go, yes, I would say that, we are looking at our investment priorities in a much, much stricter way. We have to meet our obligations and managing our costs. Having said that, we remain completely committed to some of the bigger investments that was pre-COVID, which was committed. Things like our entry into China, post our license approval in February. There's a whole work stream and execution of enabling our technology platforms, entry into China. We remain fully committed to that. We're also implementing and working as we speak on the Asia Pacific real-time hub for fast payments. The first country to go live is going to be Philippines at the end of the year. And those investments and commitments, we remain strongly on course, with them. So no big shifts in strategy, no big shifts in the commitments we have in the market, but it's really optimization and making sure we are being prudent in the way we are deploying our resources.
And Ari, quickly, earlier this year we heard from China, the PBOC, approving the MasterCard to create a bank card clearing business. It seems to be a little bit late in the game, but how quickly can you actually start operating?
Well, this is the approval came through in February, and right now we are in that execution mode. Within 12 months, we hope to be, on the ground in China, and that's where, we are. It's a commitment. It's a long journey for us to enter China. We're really excited about that opportunity.
Ari Saka, Co-President, Asia Pacific MasterCard, we thank you so much for your insights today. Just some breaking news here. We have the rupiah climbing more than 2%, in fact 2.2%, the most in 3 weeks, to 14,965 versus the dollar. It is the first time since February since the rupiah has been trading on the stronger side of the 50-day moving average. Of course, the rupiah has been under a lot of pressure. Investors have been dumping Indonesian stocks for 12 straight days, the longest selling streak since August, on uncertainty over when a partial coronavirus lockdown will end in several of the cities. Of course, we know that the extension did take place earlier. A lack of earnings guidance from listed companies also adding to those concerns. Indonesia seen as among countries that have been late in responding to the coronavirus. Again, the rupiah climbing 2.2%, the most in 3 weeks, to 14,965 versus the dollar. Still to come, India's biggest company by market value says it could be debt-free by early next year as it plans a sale to existing shareholders. We ask what to expect from Reliance Industries results next. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you in interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
During these uncertain times, we remain committed
to providing the news and data driving global markets.
To make sense of this situation impacting all of us right now.
And while we may look a bit different, we stand by that commitment. We're here for you. This is Bloomberg.
India's largest company by market value is planning to sell shares to its investors for the first time in 30 years as it steps up efforts to pay down debt. This is the third fundraising Reliance Industries has proposed in recent weeks. Let's get more now with our India conglomerates reporter PR Sanjay joining us with the latest out of Mumbai. So Sanjay, tell us a bit more about this. What do you make of this proposed rights issue?
Hey, thank you. As you rightly pointed out, this is first time in its history of 30 years. Which also means that promoters are very happy about the company and they're trying to instill some confidence among investors. So when the whole world is going at disbelief rally and the whole world is seen on pessimism, Reliance is using its cash to get some more capital, and this will also help them to bring down the net debt level to zero by next year. So this was the promise made by Mukesh Ambani, the chairman of Reliance Industry, last year, that he will bring down the net debt level to zero. So this step is the third recent step for capital raising. One was the potential ambitious Saudi Aramco deal, and second one was Facebook deal, and this was the third one. And we are awaiting more details during today's board meeting regarding the ratio and other details.
Sanjay, let's just take a look quickly at how the markets are looking in India. It's just open. Nifty futures are pointing to a higher open. Let's see if it is higher. Indeed, of course, the concern still, investors see stress in the system. India now considering a proposal to guarantee as much as $39 billion of loans to small businesses as part of a plan to restart the economy. Perhaps that's giving investors some confidence. The Nifty are currently up by 1.9%. The Sensex also higher by almost 2%. We are seeing India joining in pretty much a broad rally in Asia, lifted by sentiment in the U.S. We have, of course, strong earnings. And taking a look at Reliance stocks, it is out with earnings, as we said earlier, along with Hindustan Lever and Tech Mahindra. Reliance up by about 1% in the lead up to those numbers. Talk to us, Sanjay. What are investors looking for when Reliance announces its earnings today?
Investors are very keen to look for various commentaries. Reliance is no more an energy company. Reliance is trying to convert itself into a technology company. Hence, there was a Facebook deal. So, the Reliance Industries investors would be keenly watching out for the numbers for the new business, which includes consumer and telco. So, any kind of decline in margin from their oil and refining business would be offset by these new numbers, which includes the new subscription numbers from Reliance Jio, and more retail users would be keenly watched by investors. And definitely investors will also be looking for various monitored divestment plans, including Saudi Aramco. Any update on Saudi Aramco will excite investors, and anything that will help Reliance Industry to make the net debt zero would be keenly watched by investor community today.
We await those numbers. India conglomerates reporter PR Sanjay Mumbai, thank you for that. Now, pulling more to come. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Singtel and a group formed by StarHub and M1 have won bids to launch 5G technology in Singapore. The country's Minister for Communications and Information, Aziz Warren, spoke to me exclusively about the city-state's push to establish its high-speed network.
This is a license for 15 years. So it is not about recovering the investment or accruing the returns on the investment in the first 2 to 3 years. It is about taking a long view and establishing the value proposition. The second point I would make is in terms of the order of magnitude of the investment. Well, I think if you take reference from what has occurred around the world, it will have something, that will probably run into hundreds of millions and probably billions of dollars in a cumulative basis. The third thing I would say is because of the way it is being staged out, where 50% coverage by 2022 and thereafter 2025 for nationwide coverage, it also allows the telcos to space out their investment flows in order for the development of the assets and the infrastructure. So I think there is enough flexibility, and in terms of the tenor of the investment, it is long enough, I think, to take a long view to recoup not just the investment, but actually attain significant returns on it.
How much is the government collecting from the allotment of the spectrum?
So we had specified, and I think the clearing price for the spectrum in this round, in other words, both parties will pay $55.01 million. Now that, if you do an international benchmarking, comparing it with, if you normalize it for population, for duration of the license, plus the spectrum, 100 megahertz that we are awarding, it is somewhere in the median of international benchmarks. The key point also I want to emphasize is from the very outset, our focus has been not just about getting a return in terms of what is paid for the spectrum. It is actually in terms of the overall investment that the telcos undertake in order to maximize the benefit to our economy. So the price that they pay was only 15% of the overall calculation. What was in fact weighted more heavily was what value they can bring in terms of value-added solutions to businesses, in terms of solutions for consumers. And this was an important part of the overall evaluation in deciding what value they bring.
Minister, are any of the telcos planning to use Huawei equipment in their 5G implementation?
We have not specified any vendors. And in fact, our approach has always been to emphasize at the system level, our requirements in terms of security and resilience, and any telco providing the network will have to meet IMDA's regulatory requirements on that score. And then we've also wanted to ensure that there's vendor diversity, so have a certain level of resilience in the system. And on the second part, on vendor diversity, based on the short list of vendors that the telcos have made available to IMDA as part of the CFP process, it's quite clear that we will have vendor diversity in our system. No specific vendor has been excluded.
Can 5G networks, including that of Singapore, provide a high level of service or performance without Huawei?
I think that's a technical question, and it's best put to the telcos. But I think this is where, in the process, there will be technical evaluations, and I think the telcos will have to evaluate the solutions put forward by the various vendors. I would point out that not just Huawei, but the others like Ericsson and Nokia are also vendors for 5G systems around the world. And so I think in the end, it's going to come down to, on the one hand, the evaluation from a commercial perspective by the telcos. On the other hand, they must meet their obligations under the CFP proposals and the regulatory requirements in terms of security and resilience that IMDA has specified.
And that was Singapore's Minister for Communications and Information, S. Iswaran. Take a look at some news here, just crossing the Bloomberg when it comes to Virgin Australia. Of course, Deloitte has already kicked off the sale of the airline, and they're seeking to have that deal completed by June. Well, Deloitte's saying that those talks continue with 12 parties when it comes to Virgin Australia right now, and Morgan Stanley and Houlihan Lokey is going to be running that sale process. They do plan to have those binding offers due in June, and they're thinking to complete a deal by June the 30th. Also, they held their first meeting with Virgin Australia creditors as well. Of course, the proceeds from this sale would have to pay back those creditors, of course.
Vaughn, let's do a quick check of the latest business flash headlines. India's top court has dismissed an appeal by Vodafone's local unit that was seeking a tax refund of about $630 million from the government. The panel agreed the return of only $96 million before closing the case. The ruling is another setback for Vodafone after Indian mobile operators were ordered to pay a combined $19 billion in back dues. Vodafone owes about $7 billion of that. Facebook reported an 18% increase in fiscal quarter revenue, showing advertising demand was strong before the pandemic hit. And it says business was steady in the first few weeks of April, setting stock surging. Facebook sales came in at $17.7 billion for the March period. The results covered just a few weeks in the month when lockdowns began to hammer the global economy. And Microsoft quarterly sales and profit rose, buoyed by demand for internet-based software and cloud services to accommodate a shift to remote working. Net income through March climbed to almost $11 billion, while sales rose 15% to $35 billion. Profit came in at $1.40 a share, topping analyst forecasts of $1.28. Shares rose in late trading. SoftBank has widened its net loss forecast for the fiscal year through March by 20% to 900 billion yen. That's around $8.5 billion. Masayoshi Son has been struggling with the effect of the coronavirus on his portfolio of startups from WeWork to Uber. But despite the forecast revision, shares in SoftBank rose in Tokyo trade.
All right, taking a look at markets before we go. It is going to be Labor Day holiday tomorrow. So, of course, it's a shortened trading week for many markets out there. Hong Kong has already closed along with South Korea today. Take a look at markets, though. There's plenty of green on the screen. Taking a look at the Nikkei 225 coming back from that lunch break and breaking above that 20,000 mark. We have Asian stocks on track for the best month in 4 years. Chinese stocks, though, still the underperformer compared to what we've been seeing for the rest of the region after we did enter and re-enter that bull market for MSCI Asia yesterday. And we're watching Singapore as well. We've seen the best day in 2 weeks for that benchmark. That's it for us here on Bloomberg Markets Asia. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
This is Bloomberg Daybreak Middle East. Our top stories this morning. Fed Chair Jerome Powell expressed his confidence that the coronavirus crisis could leave permanent scars on the U.S. economy and says policymakers of all stripes need to do more to limit the damage. President Trump sees light at the end of the virus tunnel. Project Warp Speed aims to drastically cut the time it takes to develop a vaccine. And the chairman of Dubai-based property developer Damac says the 2008 financial crisis will seem like a piece of cake to what he calls a corona crisis, but insists his company will pull through. Here are our exclusive interview with Hussein Sajwani this hour. So it's just struck 8 a.m. across the Emirates. It's Daybreak Middle East, the last day of the week. We got there. So what are markets being driven by? A warp speed coagulation of the military, of government, of tech earnings. So it is Project Warp Speed and the potential of a drug from Gilead that's driving the alpha of equity markets around the world this morning. Now, when you look at what's happening in Asia, you take some stock from what the Fed Governor Powell said last night. For a robust recovery, we need all parts to join in. So really pushing on the fiscal narrative there. The dollar index this morning actually breaks trend. It's the first rally, or bid, I should say, in 5 days. Why? Why has the dollar suddenly turned around after 4 days of reduction in a risk-on environment? Well, the Fed signals it is a long way from the V-shaped camp recovery. That's according to Deutsche Bank's analysis by Mr. Ruskin. By the way, the U.S. economy did contract by nearly 5% yesterday. So the scale of the damage to be done. Now, I want to talk about what drove the markets. It was two individual, well, there's three stocks, but we haven't got time to do everything. But Microsoft, working from home, if you don't pay, you lose. The model is less about the consumer and more about business. This is the after hours, up 2.8%. Sales up 15% at $35 billion. But this is the puppy. Have a look at Facebook. When you're at home, are you really working? Are you really telling the truth? Because I'll tell you what, a lot of you are on Facebook. 1.73 billion of you are on Facebook, the core product. At December, that was 1.66 billion. You're also on Instagram and WhatsApp. Your daily usage of Instagram and WhatsApp is blowing it away at 2.36 billion, up from 2.26 in December. Now, they did guide a little bit on the stability of advertising. So I just want you to IB me whether you really are being productive or whether you're being a little bit naughty and on your Facebook page and on your WhatsApp. I've blown through all my data for this month. Let's talk about the Fed and the message from Jay Powell, because he says that the coronavirus has brought the economy to an abrupt halt. That as he held interest rates near to zero, pledging to keep them there until the US is back on track. Now, Powell talked of a heartbreaking harm that the pandemic has caused and said activity will likely fall at an unprecedented rate in the coming months.
The forceful measures that we as a country are taking to control the spread of the virus have brought much of the economy to an abrupt halt. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing and support from Congress and the Treasury. It may well be the case that the economy will need more support from all of us if the recovery is to be a robust one. It probably will take some time for us to get back to a more normal level of unemployment. We're not be in any hurry to withdraw these measures or to lift off. This is the time to use the great fiscal power of the United States to do what we can to support the economy and try to get through this with as little damage to the longer run productive capacity of the economy as possible.
That was the chairman there of the Federal Reserve, Jerome Powell, just a synopsis of what he had to say. Here is how some of the top Bloomberg commentators reacted to the Fed's decision and Powell's comments.
I think the Fed's statement is exactly right, that we're going to have some the ongoing public health crisis will weigh heavily on economic activity in the near term.
The likelihood that that the Fed is going to be able to jumpstart this economy with extremely accommodative monetary policy, I think, is remote.
How much are we seeding bubbles out there for the future? The problem is the Fed just can't worry about that until that becomes a major issue. What they ought to worry about now is getting through this crisis.
Let's bring in Kirk West, Executive Director of International Business Clients at Principal Global Investors. Kirk, thank you very much for joining me. So to reflect back on what Mr. Guggenheim had to say, what Mr. Maynard had to say from Guggenheim, the Fed cannot jumpstart this economy. And I reflect on what Powell said. We have lending powers. We have lending powers, not spending powers. So is the next evolution of the narrative to the fiscal narrative rather than the monetary?
I think the narrative continues to be that we will be there and we will act in whatever way is needed. And I think the Fed is doing exactly the right thing. This roadmap to normalization is going to take time, and there's going to be some disappointing days on the path.
I also was drawn to a line from Powell. Our credit facilities remain wide open. I've been looking at investment grade. I've been looking at junk bonds. We put it into the library. It'll come up in a moment. Now, this language, our credit facilities are wide open. We can do more on that front. Now, that's what draws me to the junk bond movement that you've got on the investment grade flurry, these moral hazard trades as they're referred to. Does this give new wind to a compression in those spreads?
Well, I think the Fed is, again, absolutely correct in focusing on the orderly functioning of the market, and that's right across the credit curve. And we at Principal feel very comfortable at the investment grade end. I think they're also right to be sending a very positive message at the high yield end. But while that sentiment may be very positive and reassuring to the markets, at the end of the day, it will be the balance sheets of those individual companies that determine if they see it out. And that's where we would have concerns at this point.
Well, how's that going to play out, Kirk, in terms of, are we really prepared for the magnitude, perhaps, of busts that might come? How does that play out for you?
Well, again, it's interesting, as you said, when you look at how strong the market has been. I mean, if you look at the U.S. market, it was off 30+%. It's now kind of recovered 30% off a lower base. But, over the course of 12 months, it's flat. And I think there are reasons for concern there. I mean, of course, when you break it up, and there's been incredible dispersion of returns, as you've touched on before. A handful of stocks are doing really well. The median stock is still down, well into the double digits. But again, I think, look, the markets try and play what's it going to look like in 18, 24 months, and they may well be right. They may well be right. But along the way, as I said, there are going to be some very disappointing days. There are going to be companies that don't make it. And so what I would be saying at this point is, active management should do very, very well. When I look at the markets today, I probably think equities are a little bit rich, and I would be taking my foot off the pedal there. But I do think there are some really good opportunities still to be looking for income assets, and that's where I'd be spending my time at the moment.
Given the pullback on dividends, Kirk, this has been the great debate, hasn't it? Bank dividends ravaged in Europe. Buybacks and dividends, well, the US is less dividend and more buyback-centric. But you say that that's the direction of travel for you, even with the amount of dividends and buybacks that have been slashed?
Well, that's a very good point. Of course, as you know, the biggest buyer of stocks in the US market for a number of years now has been buybacks, and we can expect those buybacks to be reduced by at least 50%. And of course, in Europe, there's been regulatory kind of pressure, or in the sense of requirements to stop paying dividends and buybacks. So, but again, I think quality stocks with strong balance sheets and predictable incomes will still be really well supported. But again, at this point, I think if you're looking for income for your portfolio, and a lot of people are, there remains this insatiable demand for income. I would be looking at the credit side of your portfolio. I do think there's some great opportunities in investment grade. I think there's some very good opportunities still in subordinated debt, say preferred securities, and also in the private assets. And for example, real estate debt, I think is going to provide some very interesting opportunities over the next few months.
Can we just finish off this conversation about where we go with forward guidance? You said the Fed did a very good job. I was looking at the pricing of what Fed fund futures are doing. Now, the market does not believe, Kirk, that we are going to get anything like even a half of a quarter of one full point of a point move by 2023. I butchered that, didn't I? I mean, normally a rate hike or drop is 25 basis points. The market's barely pricing in 12 basis points by 2023, 2024. Do you think that that's... I mean, markets tend to overreach, don't they? They tend to get either virulently on the downside or violently overly optimistic. Does 2023, 2024 sound like a bandwidth for zero rates?
Look, you're absolutely right. Markets do tend to overreach. But I would say to you that there are so many unknowns at the moment, and the likelihood of further support, stimulus, both from a fiscal side and a monetary side, is such that we're going to be accumulating an enormous amount of debt, not just in the US, but globally over the next few months. And that will, by implication, put a lot of pressure on keeping interest rates very, very low. So I think at this point, the market may well be right.
Okay. Well, it tends to overreach and then find that plimsoll line. Kirk, stay with me. We've got a little bit more work to do. Do not hang up the phone. It's the new instruction on Bloomberg. Stay with us.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
So it's in, the first official reading of the Chinese economy this month, showing that manufacturing moderated, indicating that the recovery in the first quarter slump, well, in terms of that, it indicating that the recovery from the first quarter, I suppose, for want of better words, it prolonged. Now, the official PMI, that came in at 50.8 from 53. And the result shows that you've got a continuing wide impact of the coronavirus on both output and demand. So let's take the data and see what Kirk West, Executive Director for International Business and Clients at Principal Global Investors, makes of it all. So if you were a doubting Thomas at all, you would say inside China, nascent recovery. Reality is external demand absolutely battered. New export orders slump to 33.5. You ain't going anywhere unless this really changes in terms of the external story for China.
Well, Manus, I think you're absolutely right. I think the first point is it's extremely difficult in producing this data at the moment with many things still shut. It's just getting the information to produce the data. It's incredibly problematic. In terms of the numbers that we saw today, it's not surprising that they continue to show some growth because it's coming off a very low base of what has happened in the 2 previous months. And to be honest with you, I'd put the release in the bin because it's next month and the months that follow that, which is going to give us much better signals. And again, you've touched on it on the export side, on the new orders side. It's miserable. So the real focus of China at the moment is on the consumption side. And as we saw last week, I think it was with the retail sales numbers, they were disappointing. And that should be concerning because that means that the consumer, which is now 40% of the economy and 70% of growth, the consumer is being hesitant to spend again. And that's where the government needs to focus from a stimulus perspective.
Can I ask you then why, Kirk, why are you, when I look at your briefing notes, you say, EM, I'm overweight, Asia, excluding Japan, and you lean into China and South Korea. Now, is that predicated on triple R cuts, on targeted stimulus? I had BlackRock yesterday, and they said it's going to be quite targeted stimulus. They want to be long China. So that's why I'm just trying to square the two things away here in terms of your position versus what we've just said.
Well, we certainly posted on this downdraft. We did lift our exposure to equities. Now, in doing that, we actually took off a slight overweight to EM to a market weight, and we actually went overweight developed because we think those economies, particularly the US, will recover faster and harder. But we still remain market weight in emerging markets, in equities. And again, when we look at emerging markets, we see the Asia ex-Japan, and particularly China and Korea, as being on the road to normalization. So it's the best house maybe in a bad street. But we do think there's some very good opportunities there. What I should say, though, is while we feel comfortable on the equity side, we are still underweight on the emerging market debt side. While we see there being some really good value there, particularly for absolute return type strategies, that's going to be a market which we think will still take some time to get some positive investor sentiment.
Given that, so lean into the equity, hesitant on the debt. One thing Mohamed El-Erian, I just want to draw a little bit more on that. One thing that Mohamed El-Erian said the other day is don't fade the US, EM, Europe trade. Don't fade the dollar. And he warned of sovereign default is something that we are not pricing sufficiently in EM. Do you concur with that? And how do you perhaps prepare for that?
I think he's absolutely right, and it kind of comes back to one of my earlier comments in the previous segment, and that is this is a time that active management should pay off. Asian markets, emerging markets as a whole are not homogenous. There are individual countries out there which are going to find it extremely challenging, particularly commodity exporters, particularly some of those economies in Latin America. So I think he's absolutely right to say that. But again, there are also some very, very good companies within emerging markets, and those companies will benefit from the changing habits that we will eventually come out with.
Yep, and there will be absolute changes to how we live our life. Kirk, great to get your take this morning on the markets. We wish you well. Be careful with the stocks you pick up. Make sure they're strong balance sheets and low leverage. I bet you that's the theme. Principal Global Investors, our guest host this morning. Plenty more to come on your Middle East markets. We've had a bounce in oil. How does it play out? Right here on Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
So new inflation projections in Turkey could offer a look at how much more room the central bank has to support the economy with sinking investor sentiment around the region. This is going to be one of the key focuses. Simone Foxman is in Doha as ever for the team, and she's been taking a look at what we can expect in terms of this guidance from Turkey. What's at stake, Simone? Good morning.
Yeah, good morning, Manus. Well, this is actually a data point that's going to be really closely watched, in part because of what we've seen in the lira. It is the worst performer among emerging market currencies so far this month. Now, the central bank cut rates last week more than expected and said inflation risks tilted to the downside. Its previous projection for inflation at the end of the year was 8.2%. Now, economists generally don't agree with what the central bank says inflation is or will be, but if the central bank cut this below 8%, that really would open the floodgates for more easing, and of course, you know what that means. That's more pressure on the lira, but also potentially more support for the local economy.
Now, of course, we had a red headline, and we really are focused when we see these from ADIA, Abu Dhabi Investment Authority. They're delaying the sale of, what, $2 billion worth of private equity stakes. So tell me a little bit more. What do we know? Because it's not just them on their own that are suffering this, is it?
Well, this is really interesting because through last year and the past year or so, we've seen a really roaring market in private equity secondaries. So folks like ADIA had invested with private equity money managers, said, we don't want to be invested in this with this money manager anymore. We want to do more on our own. So it had about $2 billion worth of those stakes that it had wanted to get off its hands. Now, the issue here, according to our reporting, is that the money managers and ADIA no longer agreeing on what the underlying value of these stakes are worth, and that, in fact, may have to restart the sales process in the second half of the year. But this kind of taps into a broader question that we're asking is how much are sovereign wealth funds going to be part of an effort to support local economies, given the fiscal pressures from oil, from COVID-19? And that makes it more difficult if it's going to have issues divesting those assets. It just means that sovereign wealth funds going to have a harder time being there as a resource.
Yeah, but that comes back to the discussion around liquidity, doesn't it? If you look at some of the deals that Abu Dhabi did, for example, with the pipelines, they were done in much better times when valuations were easier to decide. Now, in terms of ratings and liquidity, this is critical because Moody's cut the credit rating for Dubai Power and the water monopoly. That was yesterday. So I just want to get a sense of the credit health here in the UAE because Dubai's been doing private placements, but we haven't seen a Eurobond issue since 2016. So talk me through the credit analysis that you've seen.
Yeah, well, one of the reasons that Dubai may be doing that private placement is, in fact, as Moody's says, that the fiscal implications of COVID-19, of oil prices and negative growth in the region are really most acute in Dubai. And that particularly because government-related entities like the Dubai Electricity and Water Authority may need financial support. Now, that entity is still investment grade, rating cut to 2 levels above junk, and going to be affected by the decline in the expat population, according to this latest rating shift. It's notable that these ratings agencies have been more active than they were in the financial crisis. They came under a lot of fire for not being as proactive as maybe they should have been. But, look, I think there is a broader concern about the underlying creditworthiness of various entities in the UAE. Emirate of Sharjah, the outlook there was lowered to negative by S&P earlier this week. That's also at the second lowest investment grade score. The UAE is strong from a fiscal health perspective overall, but we certainly are seeing credit issues that could be percolating below the surface that, would show up across asset classes, man.
Yep, and it's really going to take time to unfold. Simone, great reporting there from Doha as ever, tracking the markets, the credit analysis, and when ADIA moves, the rest of us really do sit up. So this is State of Play on the markets. You have Jerome Powell calling, one would say, for fiscal movement by the political side. You've got this, I suppose, optimism really being driven from Gilead and the possibility that remdesivir will be our sanctity in a COVID world. Microsoft, Facebook, and Tesla delivered resplendent results that the market really quite liked. We'll discuss the markets. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. and the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil, the Bloomberg Commodity Index.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Dubai's property market was already under pressure long before COVID-19 and the oil price crash. And the prospects for many developers are looking even grimmer now. But the chairman of Damac Properties is adamant that his company will pull through. Hussein Sajwani spoke exclusively to my colleague Yusuf Gamal Al-Din.
This crisis, in my view, it's one of the biggest crises mankind is facing. And the challenges are enormous. This is going to be nothing, 08 going to compare like a piece of cake to the Corona crisis. I mean, leave apart from Dubai, this is something very global and it's very severe. I mean, some health organizations are expecting in a second round, we could see 1 billion people infected. Just even if it's 100 million. I give you one example. In Japan, out of 4 ambulances, only 1 reaches the hospital barely on time, and the other 3 have to wait 9 hours. How many people today are dying, which I know some people personally have passed away in UK, nothing to do with Corona, could not reach the hospital because he had a heart attack. You know, so the situation is very, very severe and very serious.
So how does that affect how you look at what the company might be able to pull off this year?
See, my advice is to the global business leader to be ready for the worst. I give you an example. In 08, my biggest strength was how I saved the company. I was ready for the worst of the worst. Where my colleagues, my other business friends, they were saying this is a matter of 3 to 6 months. And I went at the time to the banks and negotiated 3-year extension. And the banks were telling me 6 months is sufficient enough. Today, in Damac, with alhamdulillah, with God's grace, we've been ready much earlier. In 2018 and 17 December, I saw that the market going to soften. And as you know, last year in October, I told you the market is in a difficult shape and we need to stop the supply. You know, the silver line here in Dubai, the government has done a great job of controlling this disease. Of course, nobody is perfect and yet we have a lot of work to do, but they've done a fantastic job.
Yeah.
We in Damac, few things which we did in the last 2 years. Number one, we did not do any launches, only 1 launch last year for a small building. And even the year before, for about 2.5 years, we did 2 small launches. Number 2, which is the most important thing, we did not give payment plans at 5% upfront, 5 years extension. And we were very strict on that. And I remember the same thing in 07, which saved us. In 07, a lot of developers giving 5%.
Yeah. If I could just interject here, you're saying you're taking the steps proactively. You've been critical in the past of the real estate management committee that is looking to trim down the supply a little bit. Has the committee lived up to your expectations in the last 3 months? And are your competitors finally doing their bit to contribute in terms of cutting back on projects?
To answer you frankly, today my competitors are forced to. They have no choice because their receivables is going to be huge. I understand already some of them frozen or halted some projects, and they're going to cancel some projects. So I don't think by any logic, when they're canceling projects, they're going to be doing new launches. So today they have no choice. And they have to manage their, of course, everybody has to manage their cash flow. So if there is any silver line in the subject, I don't think there are going to be any more launches. If the launch is going to stop, most of the 20, most of the 21, I think in October 21, when the expo starts, we could see market start changing in a positive view. Today, I think it's a great opportunity to buy because products are selling in secondary market below the replacement cost. And actually, there are people who are coming and looking for a bargain. And I get messages from my management, okay, sometimes for ridiculous price, some time for a price that we can negotiate. So we're still selling at a much lower price. In Denmark, we're going to suffer this year from the P&L point of view, but our cash flow is sufficient, and we're taking enough measures to weather the crisis.
The coronavirus has reshuffled quite a few capital trends in terms of flows, but also generally movement of people and goods around the world. What are you seeing in terms of changes when it comes to your buyers? I mean, you're saying there's a lot of appetite. People are still coming up and looking for good deals. Is it still the same crowd that's coming to the market from China, for example?
We don't have a lot of Chinese, but we have customers around the world. And yes, as I said, I see a lot of customers coming looking for a bargain. There's money around the world, and especially in the third world countries, in that 1% or 2% wealthy people, and they're looking for a bargain, and they're coming and looking for that.
So are you selling any assets at all, planning to dispose of any of your, let's say, valuable portions in your portfolio to safeguard liquidity and ongoing obligations?
No, as I said, alhamdulillah, we are not under any pressure. We are not canceling a single project because most of our projects are 60% and more. We continue. We have enough money in the escrow to build the whole our entire project without any delay. We are focusing on the cash, on the collection. Yes, we're giving some discounts and some incentives for people who are willing to pay, let's say, ahead of time or on time. That's the thing we have done for the customers. But for the new sales, we have reduced prices to 5 to 10% in certain areas, but we're not reducing more than that.
The folks at Standard & Poor's put out a report saying that Dubai property prices are going to retest the lows that we saw 10 years ago. Moody's put a note out as well just in the last 24 hours warning that the imminent impact of the coronavirus in terms of economic activity. What would you tell the leadership in the United Arab Emirates about what else can be done?
I mean, I know they were working very hard to improve the demand, which was very important because you don't look at one side of the supply. Demand is very important. No matter how much supply you have, if you have